over to you คุณเนติตา
Thank you so much, Kun Jesada, and good afternoon, everyone at the event and everyone who is joining by Zoom today. The first session for Thailand, we will discuss about Thai economy, the impact of global economy to Asia equity, and foreign fund flow into Asia, including Thailand. I have two very special speakers today. The first one, Dr. Kirida Paupijit, Director of TDRI Thailand. สวัสดีค่ะ
สวัสดีค่ะ
And Mr. Aninda Mitra from BNY Mellon Bank Singapore to join us via Zoom call. Hi, Aninda.
Hello, how are you?
I'm good. Okay. We will talk with Dr. Kirida first, but before we start, please allow me to give a brief introduction of Dr. Kirida. Dr. Kirida holds a PhD in economics from Cornell University, and she is the director of TDRI Development Research Institute, an independent think tank in Thailand. Prior to this, Dr. Kirida was a senior economist for Thailand of the World Bank Group for 15 years. She also has a significant regional experience in Laos PDR, Cambodia, and South Asia. So, Dr. Kirida, the Thailand economy has been hit hard by pandemic for almost 3 years now. And we are currently facing a multiple of headwinds such as Russia-Ukraine war, inflation, and interest rate hike around the world. Is it even possible to say that Thai economy recovery is on the way?
Thank you so much. First of all, swadika everyone here, and good afternoon everyone who's here online as well. So, Kunet has a good question, whether Thailand has already recovered or is it recovering. If you remember, in 2020, the Thai economy actually contracted by around 6% year on year. And last year, it expanded or grew by only 1.6%. So we are still far away from our 2019, GDP level. But this year, I think we're seeing a stronger recovery. We are expecting the Thai economy to grow by around 3% this year. And I have some slides to show you, why do I think so. So if you can just put up the slides, that would be great. So, is recovery on the way? I would say, just to give you, the key message here is that I think it's on the way, but there are so many downside risks, which I will point them out to you, in a bit. So if you look at the Thai economy, it's always good to also look at the global economy first, because the Thai economy is a small open economy and it's very dependent on the global economy, through trade, through tourism, through investments. And we've already seen that either the IMF or the World Bank has downgraded global growth this year from what they had expected. But as you can see on the left-hand side, the world is still growing, right? It's going by, 3%, 3.5%. So it's growing, but it's not growing as much as we had expected earlier in the year before the Ukraine-Russia war. And this actually is a result of the high inflation all around the world, the hike in interest rate in the US, which has prompted many other countries to raise the interest rates as well. So that also sort of dampens, growth as well. And of course, the stronger US dollar, right, that, has come about as a result of the higher, the potential hike in the US interest rates and the quantitative tightening that's coming about. So the stronger dollar for many countries that are in debt, pose an issue for them because they will have to repay their foreign currency debt, especially the dollar debt, at a higher cost. So, so that all these have, dampened growth this year. And you can see that, the IMF has downgraded growth for most countries, most big economies in the world, except for Japan, which will be growing this year by more than last year. So, given this context, Thailand, of course, depends a lot on these major markets. And, we export to them, we import from them. And also, we rely on tourists and also investments from them. So I would say that, Thailand will grow, but it will not grow as much as we had hoped in the earlier part of this year, as well as the global economy as well. But we can see that because of the impact of the Ukraine-Russia war, one of the major headwinds is inflation. It's the high cost of commodities. For Thailand, it's particularly the oil prices. Of course, there's fertilizer prices, there's steel prices, there's some wheat prices, which we use to make our instant noodles that many of us are a big fan of. But that's not a staple food for Thais, right? A staple food for Thais is rice, and rice prices have not risen much. So, but again, with the higher commodity prices in the world, it has pushed up oil prices and food prices in Thailand as well. And oil is one of the biggest push in the Thai inflation at the moment. And there's a forecast that for the rest of this year, oil prices will remain over $100 per barrel. And it may soften a little bit next year if there are adjustments in the supply chain, or if the war in Ukraine sort of subsides a little bit. But again, it will be at a high level. It will be over $100 until next year. So this, of course, poses inflation for Thailand. But the other good news on the global front is that many countries are recovering from the COVID-19 pandemic, and they are reopening. Hence, there's more income, from domestic demand, from tourism that's coming. Now we're already seeing 123 countries in the world opening up without any tests for tourists, and that's a good sign, including Thailand as well. And I'll talk more about the Thai, tourism in a bit as well. So this is part of the good news. So all the inflation is high, but we have sort of, put the pandemic. I have to knock on wood to say that, put it behind us and hope there are no new variants that will come about that will dampen domestic demand again. What about the baht, right? We've seen the baht becoming very weak in the past few months, and that's mainly because of the higher oil prices and import prices. So when we need to import them, we need a lot more baht to pay for them as well. So here again, we're seeing that the baht has weakened, and I've looked at the consensus forecast, which is a average of many of the investment banks' forecast on different currencies. And we see that the baht has actually weakened by more than other currencies, in the region. And that's because we don't still have not really received inflows from tourism in a big way yet. And our trade account is in a deficit because we do now import, as I mentioned of you, more in dollar terms due to the higher oil prices. So given that, the dollar is strengthening, and we're not seeing so much inflows coming into Thailand, the baht has really weakened. So it's now, I think, the second weakest, right just after the Japanese yen. And there is a forecast that by the end of the year, the baht will probably, go maybe to until like 33.5 baht to the US dollar, or even below that. So here again, we're seeing that the baht will remain weak. And I've also brought, a longer-term forecast for those of you who are interested on the different currencies in the region, including the Thai baht as well. So of course, this year will be the year that most of the currencies will weaken compared to the US dollar. But from next year onwards, it seems like there will be, some sort of a recovery as, commodity prices, as I mentioned earlier, oil prices might not rise by much more. So this is going to help currencies in the region as well. I think the only exception here I see is India. The green line, which its currency will continue to weaken. But for all the other currencies in the region, it seems that it will sort of slowly appreciate going forward. So this is where we are. But again, the Thai baht is pretty weak compared to other currencies in the region. So for Thai exports, that's good news, right? Because the baht is weaker. So when we export and we convert our dollar receipts into baht, we get more baht for exporters. But of course, for imports, it's more expensive in terms of baht. And this has actually, of course, translated to higher oil prices and inflation in Thailand because of the weaker baht and because of the rise in oil prices in the world. Plus, many of the subsidies on energy, whether it be diesel prices or whether it be cooking gas, has been reduced. Subsidies on those have been reduced by the government as well. Not because the government doesn't have money, but that's because the government would like to discourage people from using energy in an extravagant way. So diesel prices, for example, have been allowed to go up to 32 baht to a liter, about $1, a little less than $1 per liter. I mean, that's not much, because if it's left to float on market prices, it should be around 40 or 41 baht at the moment. So there's still subsidy, but the subsidy has been reduced. So as a result, you can see retail oil prices in Thailand rising, and that contributes to the inflation in Thailand, because of course oil prices affect the logistic cost in Thailand. So again, this is where we see one of the major risks that is coming about, which is inflation. So if we talk about inflation, let's look at the consumer price index and the producer price index, which not many people look at. To our surprise, the producer price index have risen actually by even more than the consumer price index. That means that the cost for producers have been rising much faster than the cost for consumers. And that's because, as I mentioned, raw material prices, oil prices have risen, but producers are still reluctant to pass them on fully to the consumers for many reasons. Maybe they want to keep their consumer base. Maybe they're afraid that consumers might not have enough to spend on their products. So we are seeing that even though we see inflation, which has peaked, by the way, in May, Thai inflation is 7%, which is highest in 13 years. I think for the whole year, inflation, for example, next month and the future months, could rise a bit more before it slows down. So for the whole year, we think inflation in Thailand would probably stand at around 6%. And don't forget that the producers would probably have to pass on this increase in cost to consumers, sooner or later, because they can't hold this on for a much longer time. Which we already hear in Thailand that some of the consumer products have raised their prices by a little bit already, such as the instant noodles that I had mentioned. So so this again is a risk for Thailand. I mean, 6% inflation for many countries is not high, but for a country like Thailand, which is used to 1%, 1.5% inflation rate, this is high. But again, one of the things that people ask a lot is that when inflation rises as much as 6% this year, will interest rates rise? Will the Bank of Thailand raise its policy rate? And I think the short answer that I have today is no. We believe that the Bank of Thailand, or the Monetary Policy Committee, will hold interest rates or policy rates, still, at least until the end of the year, because they prioritize growth more than other things. Because remember, in Thailand, the inflation is cost push. Right? It's imported from other countries. It's not because the Thai demand has grown so much, like in the US, that the Bank of Thailand needs to increase interest rates to stop demand. That's not the case. Here, demand is still recovering very slowly. Tourists have not really come back, or come back in a small way. So, raising interest rates will not help much because the inflation is from abroad. On the other hand, raising interest rates will really hurt small and medium enterprises, will hurt households, because our household debt to GDP level is now 90%, 90. So, this is not a time to be raising policy rates or interest rates. So if you look at the commercial banks rate, whether it be on the left is deposit rate and on the right is the minimum loan rate, they've also kept it quite still as well. But of course, banks do choose clients. When interest rates are kept low, they probably would not lend to grade B or grade C customers, right, clients. So that's again another issue where SMEs will have more difficulty in accessing loans even today. So that's the story on interest rates. So given all this, how do we see the Thai economy performing this year? As I mentioned earlier, we think the Thai economy can still grow by around 3%. Of course, from a low base, as I mentioned in 2020, we contracted by 6%. Last year, we grew by only 1.6. This year, we're growing 3%, so we're actually not back to the 2019 level yet. It will be next year before that high, GDP value goes back to the 2019 level. So it's gonna take around 3 years before it goes back. But again, we're seeing recovery, and that's primarily because we're opening up our economy. If you remember, last year, we had shut down because of the COVID pandemic for, since, I think if I remember correctly, since April all the way until September before we started reopening. So that's several months of closing. But this year, for the whole year, at least, for now, we think we will be able to open the economy for the whole year. And that actually have a positive impact. Because remember, last year, some companies or some individuals have lost their income maybe by 50%, by 100%, right? So this year, if they could get back at least 50% or even 20% of their income, while inflation goes up by 7%, I mean, that's still, right? That's still positive gain for many consumers, individuals in Thailand. So again, even though inflation is high, but I think the fact that we can open up and have increased incomes for different companies and individuals do help with the recovery. But of course, inflation will dampen the recovery in consumption. But we're still seeing increase in exports, growth in tourism, and private investment, which I will explain in the next few slides. So as I mentioned, in consumption, we're already seeing an increase in consumption back to its pre-COVID level. So in the chart above, if you look at the dotted line, that's the private consumption index that the Bank of Thailand produces every month, and you can see that it's already above the 2019 level. If you look at the lower chart, that's actually a more a higher frequency chart. It's the Google Mobility Index that comes out every day, and we can actually track it's mobility though, so it doesn't mean that people go and spend, but they actually move themselves to malls, they move themselves to their offices, they move themselves to different places, and we are seeing that mobility increasing. But since the Ukraine Russia war, it has slumped a little bit. But we still believe that it should, recover to its pre-COVID level, for this whole year. So, here again, we're seeing some recovery in consumption. What about exports? Again, exports and consumption are two big items in the Thai economy. Many people think about Thai economy, they think about tourism, but actually, exports of goods is 55% of our GDP. So if exports do well, or consumption, which is 50% of our GDP, does well, that actually helps growth in our economy. So let's see how exports is doing. So exports actually grew quite a lot last year. Last year it grew by 17%, which is not from a low base, by the way. I also looked at the value in US dollar terms, and it's even higher than the pre-COVID value. So exports have really, really done well last year to our major markets. And you can see here our major markets are the US, Japan, China, EU, ASEAN. And it's pretty much equally diversified. We're not dependent on a single market. We're pretty much diversified if you look at the share in the last column. So here again, we're seeing that there is recovery in exports. And this year, we're expecting exports to be able to grow by about 5%. So on the top of a very high base last year, we're still able to grow. And so far, it's mainly come from the recovery in the ASEAN markets, and we're able to export to ASEAN markets quite a lot since the beginning of this year, and to the Middle East as well. So here again, we think exports will still be a key driver of our economy this year. Now, what about tourism, which I mentioned. International tourism receipts is around 12% of our GDP. It's much less than exports of goods or domestic consumption. But it does have some impact when it slumps, because it also impacts on the incomes and therefore the consumption of people in Thailand as well. If you look at the international tourism, it's slowly picking up. It's much, much better than last year. Last year, we only had 400,000 international tourists coming into Thailand. This year, we're expecting around 6 million. For the first 4 months of the year, we already have around 700,000 international tourists. So till the end of the year, as we open up more and more and we relax all the testing and the quarantine rules, there should be around 5 to 6 million tourists. It's still far away from our pre-COVID 39 million tourists per year, but it's a big improvement from last year. So here again, this is another factor that could help growth this year and next year as well. What about Thai tourists? Thai tourists account for around another 6% of our GDP. That has actually picked up pretty well. It's around almost 90% of its pre-COVID period already. So that again, we'll see a pickup and will help growth this year as well. So tourism, will take time, but it will slowly pick up. The one that I really wanted to point out is private investment, because why is this important? Even though this is probably around just 20% of our GDP, it's important because when you invest, it's capacity that you can produce for the future, right? It's not just like consumption that you do this year and it's gone. But investments, have a longer term impact. And we're actually seeing a recovery in private investments in Thailand, both by Thais and by foreigners, who come to invest in Thailand as well. And we have seen this since last year, actually. So during the COVID year, like in 2020, everybody was in a shock, right? So investments have fallen. People are waiting to see. But since last year, it has slowly picked up. And it's still continuing to pick up in the first 4 months of this year, if you look at the table up there. But again, if you look at the business sentiment index, it has also picked up. It's reflected in the business sentiment index that since the second half of last year, it has picked up. So we're expecting more and more investments in Thailand. The BOI certificates that have been issued have also shot up in the last quarter of last year. The last quarter of last year is actually even more than the last quarter of the 2 previous years combined. So that means that there's interest in investing in Thailand, and this will translate into actual investments in a year or a year and a half normally after they get the certificates. So this is another good news that we see, and people ask where are these investments coming from? Of course, they're from Thais and they're from foreigners as well. So we did take a look at the foreign part, which is around a quarter of private investments in Thailand. And we see that the foreign direct investment, or FDI, is also recovering, especially in the EEC, the Eastern Economic Corridor. If you remember, in the Eastern Economic Corridor, it's like a sandbox that has given privileges to 10 new industries, which we call the S-curve industries. And these are called what we call in the right chart, the targeted industries. And we are seeing, more investments coming into these industries. And if you look at the chart on the left, you can see that the FDI that has been approved by the BOI has really shot up, and it's mostly in the EEC, in the Eastern Economic Corridor. And if you look at which industries are receiving a lot of interest in the Eastern Economic Corridor, it's the things that we're good at, right? It's smart electronics, it's next generation automotive, healthcare, and food processing, right? So food processing is a more high, the higher tech, the higher end food processing, which also includes, for example, plant-based proteins. It's there, right? It's there. So there is interest because in the EEC, those 10 S-curve industries are those that are more high-tech that Thailand is trying to promote. For example, next-gen automotive are EVs, electrical vehicles, right? So we're seeing that as well. And the interesting thing, which I looked at, is many of those are actually relocation from China. So the geopolitical tension, which is definitely a risk to Thailand and many countries around the world. But in every crisis, every risk, there are also opportunities. So we're actually seeing the relocation out of China of Japanese companies, Taiwanese companies, American companies, European companies, and Chinese companies out of China. To Southeast Asia. And these are just some examples that we've picked up in 2019 when the relocation came in a big way. Vietnam has received the most relocation from China, right? And Thailand is number 2 in the region. It's a number 2, which is a bit far away from number 1, but it's still number 2. Why? Because in Vietnam, companies can invest in labor-intensive industries, right, from footwear all the way to tablets, which is a bit more high-tech. But in Thailand, if you look carefully, companies that come to Thailand are mostly Japanese and Taiwanese companies, by the way, and they're investing more in the higher tech sector because it's not going to be profitable to be investing in labor-intensive industries in Thailand. So we have a smaller spectrum of investments, but they are high tech and they are more automated, for example. So here again we're seeing a lot of the automotive and automotive parts, electronics, petrochemicals, these are the ones that are coming into Thailand. So, given all this, I think there's positive news here because geopolitical tensions will not go away anytime soon. The Ukraine-Russia war is just a proxy war between the two sides, so it's not going to end soon too, so that's a risk. But on the other hand, we will probably see more relocations coming into Southeast Asia from China. So I just want to end here by saying that I see a recovery. I see a recovery in Thailand going this year and going forward as well. But the downside risks are pretty large. I would say the downside risk would be, of course, first of all, the high inflation in Thailand, which will dampen consumer purchasing power. Next year, maybe interest rates will start rising. Right? That's another risk as well. Of course, COVID pandemic, if there's a variant that comes about, again, that's definitely a risk. And of course, the recovery of China. That is a big, question mark because as long as China still has its zero COVID policy, it will still, be, negative impact on Thailand in terms of tourism because one-fourth of tourists in Thailand before the COVID pandemic were Chinese, and now they're not coming, right? So that's one thing. The other thing is also because of the zero COVID policy, there are lots of supply disruptions, and Thai exports to China has also been negatively affected as well. So again, China is a big factor. If next year they can open up, that will be even positive news. But if they can't, then that's again a risk that that Thailand will face for its growth. So let me just end there. Kunet, and if there are any questions, you're most welcome either here or you can type, online, and I will definitely answer them. Thank you.
Yes, thank you so much, Dr. Kirida, for a deep, detailed update on Thai economy. And we are now go to the session of Q&A with Dr. Kirida. And for those who has a question, please type your question in Slidos, which we will show you on the screen, and I will read the question for you. Okay, while we start, while we're waiting for the questions, please let me start off with a couple questions that I have first. Sure. You just mentioned that tourist account, foreign tourist account about 12% of the GDP, and how many years that we were going to take to get back to pre-COVID level at 39 tourists inbound.
39 million people, right?
39 million people, yeah.
Well, I think it will take a few more years because we're now up to maybe 5 or 6 million this year, and as long as China is not reopening, it will be difficult to go back to those numbers. But I think if China reopens, by 2025, we should be able to get back, to those numbers. But of course, by that time, we probably would want to also develop our tourism sector as well, which the government has indicated that we want to have more tourists coming into higher value-added sectors, for example, medical tourism or wellness. So that would probably mean that we probably do not need as many tourists, but each tourist, would be the ones who spend more that we would like to attract.
Do you have any assumption for next year that how many tourists inbound to Thailand?
That again would depend on if China reopens, right? If China doesn't reopen, then I would think it would not be above 10 million. Given the Ukraine-Russia war as well, let's see how it goes because it has also dampened some European tourists who are coming into Thailand as well. So, but if China reopens, we probably would see some pent-up demand. So there'll be lots of Chinese who are coming because now remember they would not want to go to Europe or the U.S. For various geopolitical reasons. So there would be an inbound into Thailand if it reopens. So it could be more than 10 million next year if China reopens.
And after the COVID, we see people have changed their consumption behavior and lifestyle, such as work a lot from home. Do you think that would be any effect on the business going forward in Thailand?
Oh, definitely. Of course, there are both positive and negative impacts, right? So those who are in the the digital circle would know that this is a very big positive impact for you. Cloud computing, right? E-commerce, e-entertainment, anything with E in front is doing very well at the moment. So that definitely is a positive impact from the work from home. But of course, there are also property sectors that will be affected, right? Or they will have to change. So many people are now, wanting to live, further away from the offices, in houses, for example. So, that is a change, right? A shift in behavior. So property developers would also need to look at that. But the ones that will be impacted most, I think, would be office space, because many companies are also now, shifting their business plans to reduce the office space that they use. I don't know if Maybank is reducing, but I know many other companies like DTAC, Toyota, have returned half, of their office space, to the lesser. So again, here, that will be the sector I think that will be impacted the most.
Okay, I think I see one question from the audience that what be the key trigger for MPC in the trading of decision between inflation and economic recovery? The beginning the discussion about rising policy rate.
Right. I think the trigger would be if they see a strong recovery in domestic demand. That will be the most important trigger. If, for example, there are more tourists who come into the country and domestic consumption is growing strongly despite all the inflation pressures that are coming, then only then would they start thinking about raising interest rates. Because at the moment, raising interest rates, as I mentioned, will not only hurt households, right? It will also hurt small and medium enterprises as well. So that would be the main trigger, is the strength in the recovery of the domestic demand.
The next question is, given weakening of baht is important of economy of Thailand, in your view, how will this, the government be intervened?
I see. So given that the baht is weak, the question is, how do I see the government intervene, the Bank of Thailand, right? Whether they would intervene to make the baht stronger. I don't see that trend yet. I think the Bank of Thailand would rather see the baht weak so that exports would do well and export receipts would increase and hence increase the incomes of people in the country. I don't see the trend that they would like to intervene so that the baht becomes stronger at the moment. I think because, again, as I mentioned, they prioritize domestic demand growth.
Okay, the next question is, what are main sector that will be impact from the inflation issue?
Right, so the main sectors that will be definitely the logistics sector because that's their main, input, which is oil. And as oil prices rise, this is the sector that is most highly affected. Of course, there are other sectors that have high reliance on oil as well. Those will be affected. For example, when I mentioned instant noodles, right? Who would think? Because remember, as oil prices rise, it also pulls up other types of oil. Palm oil prices also rise because palm oil is used to produce biofuels, right? So when oil prices in the world rise, palm oil rises, and that also affects, the cooking of different foods. So one of the reasons that the big instant noodle company in Thailand gave was that wheat prices have gone up and also palm oil prices have gone up as well. So it does also affect some of the food sectors that use quite a bit of oil in their production as well.
What are the main sector that will be impacted from the inflation issue?
Oh, that was the previous question. Yes.
Okay,
Sorry.
sorry. Are you concerned on recession or stagflation if we increase policy rate?
Yes, there's a lot of talk on stagflation right now, right? Because stagflation means that growth is either stagnant or even negative, while inflation rises. So as I mentioned, if there's an increase in policy rate, it will definitely affect our domestic demand and therefore growth as well. So if interest rates or policy rates rise too soon, I would think there is a chance of stagflation in Thailand. But not at the moment. We're not raising interest rates yet for the moment.
Okay, the next question is U.S.-China war seem to be sidelined now. And do you think U.S. or China will bring it back to the table again? And what could be the potential impact to Thailand?
No, I don't. First of all, I don't think the U.S.-China trade war or geopolitical tensions have declined in any way. It might not, be in the news as much. They are not the U.S. is not raising, import tariffs on Chinese goods, for example. But the geopolitical tensions are there. And for example, as I mentioned, the Ukraine-Russia war is actually just a proxy war between the two sides, between the West mainly, and then Russia, China, and the rest that do not like the U.S. or Europe. So here again, I do not think this will go away anytime soon, and it will definitely have impact on the global economy, not only on trade, but also on, for example, mobility of labor. Right? Fewer Chinese will be able to go to work in the U.S. or in Europe, and remember, many of the U.S. and European companies have relied on high-skilled Chinese individuals to work in their high-tech sectors, and now it's probably going to be more difficult to attract the Chinese high-skilled individuals, and of course there's also restrictions on them as well because they might bring back U.S. secrets to China. So that's one. Secondly, which is probably also quite important, is technology. Remember that these two camps are competing on technology. So it's not only trade, it's labor mobility, it's technology. If you recall, both sides are really, really competing on who's going to be the number one in AI, who's going to be the number one in, for example, VR, or even cloud computing. So there is a lot of competition there, and just to let you know that in the future, I think that the two camps will be separated. So if, for example, we want to use 6G, 6G will be two different standards between the Western standard and the Chinese standard. So you might need to carry two phones. Or if you're a company, you probably will have to have two systems if you have clients on both sides. But it's not only technology, right? The rules and regulations around them are also quite different. For example, Europe is issuing a regulation that protects data, right, and govern technology companies. While China says, bring us all the data you have, right? So if you want to trade with China, you should also give them the information on your business partners and customers. But if you're trading with the EU, they will say, well, if you're doing that, you're violating our regulation, our laws. So what do you do, right? So that will be a difficult situation for a country like Thailand, which is good. We don't take sides, but we will have to manage that pretty well as well.
Okay, just let me touch a bit on elections. If the winning party is not Palang Pracharat Party, do you think that would be a hiccup on the economy recovery?
Well, first of all, I think elections will not happen this year. Who knows? But I think it will be next year as planned. It all depends on who becomes, for example, the finance minister, right? Who becomes the deputy prime minister for the economy, who becomes the commerce minister. So even if Palang Pracharat doesn't come back, but if the other party or the coalition government has good people on the heads of these ministries, I still think things will be okay. And I firmly think that many of the policies that have been implemented by this government will not go away. For example, the electrical vehicle policy, right? It's not going to be scrapped and says, no, we're not doing this anymore. So things like that, or moving towards a greener, the BCG, the bio, the circular, the green economy. I mean, that will still continue because it's a global trend that no matter what political party comes, they just can't ignore.
My last question. I think we clearly see that Thai economy recovery is on the way. But Dr. Kiridao, is there anything that makes you feel worried or what could be an obstacle that make recovery slower than you expect?
Well, as I mentioned towards the end of my presentation, I think there's so many downside risks. And as I mentioned, then it could be, high inflation. It could be, if China doesn't open up, or if there's a new variant of COVID, or even if there's a war, a bigger war in Europe. Of course, those are all possibilities that could happen, and that, that's still quite worrying. So even though I see the recovery in Thailand going ahead, in the base case as being, steady. But again, as I mentioned, it took us 3 years. It will be next year before our economy goes back to our 2019 level. So, it's still not a rosy, a quick recovery, and there are many downside risks. So that's something that you might want to also keep in mind.
Thank you so much, Dr. Kirida.
Questions? No questions from the floor.
sorry.
Any questions from the audience here?
Yes. You have any questions?
Okay.
Okay, now let's talk with our second speaker, Mr. Aninda Mitra. He is the head of Asia Macro and Investment Strategy from BNY Mellon Investment Management Singapore. He has 25-year experiences in financial service industry. Hi, Aninda.
Hi, how are you? Can you hear
Hi.
me?
Yes, very well. I have two questions for you. In the context of global and Asia economy, how would this impact to Asia equity? And the second one is, how do you see the foreign fund flow into Asia market, including Thailand? Over to you.
Sure. So let me just restrict myself to a few comments. Over the near term, the environment still looks quite challenging, I would say. As your previous speaker pointed out, there's a few global headwinds at play. The first is very high inflation. It's a cause and consequence. It's caused by not only supply chain tightness, which peaked, by the way, in December of last year at 5 standard deviations tighter than what it normally tends to be, according to the New York Fed's Global Supply Chain Pressure Index. It's come off, but it's still very high at over 3 standard deviations tight. So the good news is it's coming off, but the bad news is it's not coming off fast enough. And the slowdown obviously has to do with the slow recovery of the supply chain has to do with continuing conflicts in Ukraine, as a result of which oil prices remain very high. There's also continuing disruptions of shipping and logistics, which you can see in the PMIs as well in terms of backlogs of orders, very long delivery times, and that sort of thing, which is taking time to fully recover. The chip shortages, for example, which affects everything from washing machines to automobiles, is, once again, will take more time to recover, and even then will continue to face impediments if upstream raw material continues to be obstructed or delayed because of the ongoing conflict in Ukraine. So supply chains and energy costs are two big drivers of global inflation. And the third thing I would point out is the overstimulation of the economies in US and Western Europe with massive stimulus back in 2020 and 2021 relative to the output gaps, which they went through with a very sharp but short slowdown because of COVID. So we are paying the price of that. Just to give you some numbers around this, for example, the labor market is so tight in the United States right now with the unemployment rate at only 3.5%. And the job vacancy rate is about 7%. What that tells you is that for every 1% unemployed, there's 2 jobs available. And Fed Chairman Powell himself has said that they want to bring it down to somewhere close to unity. So we're far from that. So the job market tightness, coupled with tight supply chain conditions and elevated energy prices, is a formidable impediment, if you will, to the outlook in the next 6 to 9 months. Most central banks in our part of the world were in the mode of wanting to nurture the recovery from the pandemic Thailand included, for obvious reasons, it hasn't recovered yet back to the pre-pandemic level of GDP, let alone the trend of GDP which existed before the pandemic. You're far from that. But in the rest of the region, more and more countries are reaching the pre-pandemic level. But again, it's hard to continue to nurture that recovery given all these other headwinds. So it's not a big surprise that we're seeing more and more rate hikes across the region, starting with Korea and Singapore, which tightened its FX policy. In India raised rates today. The Thais have remained on hold. But to circle back to your question, in the near term, what will attract flows across back into the region in terms of capital flows, not FDI, but capital flows? I'd be looking for a decent recovery and an ability to manage either the terms of trade or pose a real policy, attractive real policy rates. So if you can't have at least two out of these three, then in the near term at least, portfolio capital flows will still face a very challenging headwinds into the region. Over the long term, I agree with many of your previous speakers' views. I think FDI has continued to remain quite strong, at least as a share of global FDI. Asia has continued to attract pretty decent flows, even if you exclude China from the mix. And some of the geopolitics, I agree, play into ASEAN's advantage as well, not only because of relocation to avoid tariffs, but also keep in mind the RCEP agreement has very strong rules of origin requirements. So, if that creates some opportunities for businesses to relocate away from China and into the rest of the region to take advantage of lower costs, avoidance of tariffs in other parts of the world, and so on. So I think net over the long horizon, I think ASEAN still stands to benefit, but in the short term, you have the strong headwinds from a strong dollar, elevated commodity prices, and continuing increases in US rates, especially real rates, which creates an obstacle for risk assets. Back to you, Kunal.
Thank you. I see you have prepared some presentation. Would you like for us to show any slide for you?
Not really. I think if we have only 10 minutes left, I may not have time to go over it all. But I'd be happy to take any follow-up questions from you or from the audience if there's any.
Sure. Thank you. For audience, if you have any question, again, please type in the chat so that I can read for you. Oh, the audience here, is there any questions? You can raise your hand too. Okay, I have the questions. Are we already seeing peak inflation now? The University of Michigan survey data suggested that the mass consumer don't agree with Wall Street people yet.
Yeah, that's a good question. I did have a slide on that. I'll jump to that right away.
Sure.
Oops, just past that. Yeah. So yes, you're right in asking that question. This slide looks at the break-even inflation on the left chart. And that looks like now the data on this is a bit old, it's from a few days ago. But nonetheless, it does look like that's peak. That's the market pricing of inflation in the US. But the chart on the right shows you that it's still very elevated. It looks like it's not rising much further from its current levels, but one or two data points don't make a trend just yet. So I think that's the risk here. I mean, it's that expectation on Main Street, if you will, that needs to be turned around, even though the market would like to hang on to every sign of a pause in rates and that sort of a thing to begin to price in a turnaround in inflation. So that is a key risk. And the previous slide, in another slide, what I had was the beverage curve on the left, which again, just highlights for you the how low unemployment rate is and how tight the job market is. The job vacancy rates are much higher today than where they used to be when unemployment rates plummeted to 4% or below that level. So what that gap tells you is that there's a lot of bargaining power with labor. And you can see that on the chart on the right, which shows you wages are tracking, more than 5%. And that is completely inconsistent with price stability. I mean, Fed Chairman Powell himself has said so. So, what we need to see is a step up of the labor force participation rate. It's still stuck in the low 60s. It needs to come back to the mid 60s. It's taking time. But in the meanwhile, supply chain tightness is not something I have in charts at the moment. But those things continue to keep inflation expectations elevated. So it's going to be a pretty challenging act. And the longer this tightness continues, the higher the odds of a recession start to creep in, considering that the Fed would need to probably deliver the 50 basis point hikes, not only in this month and the next, but also possibly through the September FOMC meeting as well.
Okay, we have the next questions. Which market in Asia, in ASEAN, do you think will likely to perform well in high inflation environment?
From a country standpoint, I mean, so far at least we've liked the economies which are beneficiaries of the commodity boom. Indonesia and Malaysia have stuck out as the two economies that have benefited the most from their commodity terms of trade advantage. But even there, I'd start to be a bit more cautious, given that Bank Indonesia hasn't raised rates yet. There's a lot of hidden inflation pressure, if you will, because of subsidies which have dampened the true extent of possible price increases. But it's still an economy where, which we have preferred in an environment of slowing growth and rising inflation.
Okay, the next questions. Speaking of inflation, what is the risk that Fed might take action too hard or to solve? How should investor position asset allocation in this bi-modal world?
Yeah, so our asset, we are still very defensively positioned in equities. We prefer value over growth. Defensive sectors such as energy, utilities, materials, relative to growth kind of stocks. Anything with a high PE and a low dividend yield is something we would not prioritize at the moment. In fixed income, we are beginning to reduce our underweights. Keep in mind, quantitative tightening will kick in. It has already kicked in and will intensify in the coming months. That, for us, will play through the expectations channel and result in an intensification of the market's expectation or realization that the Fed is serious, and it will amount to at least 2 to 3, the equivalent of 2 to 3 rate hikes. And so that actually makes long duration fixed income assets start to look more attractive. So until I think there's some evidence that core inflation is beginning to slow down, and it's not slowing down. Core inflation in the US is still rising at about 0.6% month on month, which is, again, not consistent at all with anywhere close to 2% or 3% kind of inflation level. So in that time horizon, we're, number one, we're defensively positioned. Number two, we're warming up to some fixed income duration, at least by way of cutting our underweights. And number three, we would be looking at China more closely. They have, I mean, the lockdowns haven't eased, as we all know, or zero COVID hasn't gone away, but the lockdowns are easing. Excuse me, I got it backwards there. So that should create the stage for at least a sequential recovery, not a strong one, mind you, but at least some recovery over the next 2 quarters. So with that in mind, we prioritize sectors which are preferred by the Chinese authorities. Infrastructure, for example, there could be a bounce back in consumer staples as well. Tech is interesting, but I'd still like to see a confirmation of their sustainability of the tech upswing, given the talks with the SEC for ensuring that Chinese tech companies remain listed in U.S. markets, and at least some confirmation that their revenue streams are improving before jumping headlong into Chinese tech. But overall, we prefer to be neutral Chinese equities with a tilt towards infrastructure and consumer staples and possibly tech.
Okay. The next question is about the equity. Look at the correlation between real rates and stock valuations. Do you think are we bottom yet?
We're getting there, but I don't think we are quite there just yet. I thought I had a slide on this, but I can't seem to be able to find it here. So real rates have just gone back above zero, and that's a good thing. It's the chart on the left here. It's back to a pre-pandemic level. The key difference is that inflation's running right now at 8%, core inflation's over 5%. Those were not the kind of inflationary conditions which existed before the pandemic. So there is probably further to go with real rates, and there could be an overshoot. So which is why I think this could also result in some adjustment of risk assets as well, even though there is value opening up, clearly, as you can see from the chart on the right. So yeah, we're getting closer to a more attractive valuation level. I think the cheapening, but I would still argue that we're not quite there yet. And the chart on the right basically, once again, underscores the point that China's cheapened even more and could potentially offer a bigger upside given the sequential upturn, which we hope to see. And one way of sort of comparing or framing that view is to look at what's happening in Hong Kong at the moment. The PMIs in Hong Kong bounced back very sharply back to a mid-50s level. Retail sales are back, 10 or 11% growth year on year, very sharply in the last 1 or 2 months. I'm not saying China will recover that sharply, but even if there's half as much of a recovery in China, that would be a good place to be with Chinese equities for the near term at least.
Talking about
Back to you,
China.
Puneet.
Yeah, sorry, thank you. Talking about China, it looks like China is struggling in terms of policy balance now. Where are we at and what can we do?
So, we've tried to frame this in terms of its strategic trilemma. It's a sort of an impossible trinity. So what became clear is that they have conflicting goals. Each side of this triangle on your screen basically shows you an objective. The geopolitical objective is unlimited partnership with Russia and over time ultimately undermine the euro-dollar hegemony possibly. Their structural goal is common prosperity and zero COVID. And the cyclical goal is to get to a 5.5% growth target. Well, guess what? You can't have them all. You can at most, in our view, accomplish 2 out of these 3 objectives. We thought 2 or 3 months ago that they would really try to dial down the conflict by mediating between Russia and the West. And that would, keep Europe from not being undermined by a huge energy price shock. But that turns out not to be the case. I think the conflict has dragged on enough for us to know that China is not really intervening to dial down the conflict. So if the conflict goes on, then they'll have to pull back on some of their structural goals. And that's exactly what's happening. They have reduced the restrictions in the property sector. They're lifting restrictions on the tech sector as well. There's these anecdotes about the investigations into Didi Chuxing being concluded in the next few days. So they're dialing back on that. They haven't dialed back on zero COVID. Now that's a revealed preference in their overall structural goals. But nonetheless, in terms of common prosperity, there's been a significant dialing back alongside a bigger cyclical thrust through fiscal channels, through local government borrowing and spending and that sort of thing. So, we think they'll get to 3 and change in terms of overall growth this year, and most of that will show up in the next 2 quarters. So that's what keeps us a bit more constructive on China, but we still need to see a bit more evidence, at least on the tech side, that the discussions with the SEC are going reasonably well.
Okay, we have questions about the investment strategy. When you talk about being defensive, can we say that we should overweight value versus growth stocks?
Yes, in short, yes. We saw a turnaround in consumer discretionary, for instance, last month, but it lasted just a few weeks. It's down 25% year on year. If you look at tech stocks, they've taken a beating. Anything with a long, with a large P/E ratio, which you would be looking at real interest rates, which you would be discounting vis-a-vis real interest rates, uh, continues to stay vulnerable. I think real interest rates, as I was highlighting earlier, possibly has further to go, more of an adjustment to go, and that could easily weigh on risk assets and long high PE stocks even further. Even though as you all know that the valuations are beginning to look attractive, but the adjustments because of where inflation is and so on isn't done yet.
Okay, seems that we have a last question here. World Bank just downgrade almost every country GDP yesterday, and China got like less than 5% now. That could be hurt their long-term goal. What is your take on China?
So my understanding is China wants to double its GDP growth by 2035 to reach a high income level. And to get to that point, it needs roughly 4.3% annual growth compounded over that time frame. It makes it more challenging, I think, to have 2% growth in 2020 and well below 5.5% this year. If you take an average of 2%, 8%, and say 4%, our forecast is 3.1. You're looking at a setback versus what's really needed over the long haul. But that being said, China can still get there if they manage to rebalance and so on. But I think even that begins to look more challenging if there's not more market reforms of the economy. We haven't seen that. We've seen an emphasis on common prosperity and other populist measures to try and reallocate resources towards state-owned entities and state-backed champions, if you will. But will that work over the long term or not if there is continued decoupling, if there's a continued diminishing of supply chains between China and advanced Western countries, and less cooperation, if you will, across 5G, across high-tech sectors, where no country can do it on their own. You need to collaborate and cooperate to get there. So that's my key concern. If that dampens long-term productivity in China, maintaining a 4% plus handle will start to look tougher over time.
Okay, thank you so much for your time with us today, Aninda. I believe I can conclude that Thai economy recovery is on the way, and Thailand is one of the country in Asia that foreign flow is still coming, even we not touched the bottom yet, according to what Aninda said. Before we have a few minutes left, maybe I let Dr. Kurida and Aninda, do you have any comments or highlight before we end the session?
Well, I would not have a long thing to say. All I could say is after listening to Aninda, there seems to be a lot of headwinds coming from the global side. So here again, as I mentioned earlier, although there is a sign of recovery here in Thailand, but we should always keep a very close watch on what's happening in the global scenario, especially on the geopolitics that's going on right now, which I don't think it's going to end anytime soon. But even that, as I mentioned, in every crisis, in every risk, there are opportunities. So I wish you all very good luck in your selection of your investments going forward in the opportunities that will arise in this crisis. Thank you.
Thank you so much. And Aninda, anything, any highlight you would like to share with us?
Yeah, I mean, one has to be patient. Don't lose hope. This is a tough economic environment. We're going through a very big shift. I think the energy price shock, at least for Europe, is a big one. This could be long lasting if you're going to at least try to reduce energy dependence from Russia over the very long term. This shock could be a bit more long lasting. So, which is why I'm a bit more concerned about the inflation outlook Supply chains are normalizing. It'll take a bit more time, but be patient, pick the right sectors, and look for opportunities, but don't dive into risk just yet. Be defensive for now. But as the other speaker also pointed out, look out for long-term opportunities as well.
Okay, thank you so much. I think we spent a good time for the first sessions today. Thank you so much, Kun Kirida, again, and thank you so much, Ananda.
Thank you.